All right. Once again, good morning, everyone. It's nice to have you on this Saturday rainy morning. I hope that it's not going to mess up a lot of things for folks, but it's all good. All right. So today we are going to be talking about introduction to business accounting. And as much as we really want to do business, we have to understand the accounting side of it because the business lies on finance. And when I say the business lies on finance, we are in the business of making profit. Now, in order for you to determine whether you are making profit or not, you have to be able to figure out where are you spending your money, and is there any way you can manage the funds effectively and efficiently to avoid waste. And in order also for you to determine whether the business you're doing is profitable or not, the only way to do this is by knowing of keeping, the only way to do this or know this is by keeping proper books of accounts. Now, as I mentioned to you earlier, this session is not to make you an accountant, but it's to allow you to be able to know exactly what you're looking for and what kind of transaction that will help you grow your business. And today, this session is going to be in two folds or two parts. Today, we're going to be talking about the theory part of accounting. And during our next session that we're going to be having on the 5th of July, we will be talking about, we'll be going through the practical session where we're going to be able to use a tool called QuickBooks to be able to understand how we use it, how we can use it to manage our accounts. So today, if there's any time during the course of this session you have a question, please feel free to bring me back or call my attention so that I can give you audience. So basic understanding of accounting. What is accounting? Accounting is the process of recording, classifying, analyzing, and interpreting the business transactions which can be measured in terms of money. Thus, accounting keeps a permanent record of all business. And as simply put, there's nothing to it beyond the fact that accounting allows you to be able to record your transactions. It allows you to be able to categorize or analyze or classify transactions in the right category, just so that you can know which aspect of your business is taking most of your money, and which of your products is generating the highest income. Without keeping proper record, it will be difficult for you to be able to figure all of these things out. And so let me give you a typical example. For someone like Marian, who is in the business of cosmetics, you're talking about running your business, you have to buy raw materials. And of course, if you buy raw materials for soap, you buy raw material for scrub, you buy raw materials like for, let's say, a body lotion. So let's say she has three products altogether: the soap, the scrub, and the lotion. Now, she spends money on buying the soap, raw materials, the raw materials for all the three products. However, by the time she analyzes her account, she realizes that even though I'm spending so much on buying materials or producing soaps, I am not generating as much income in soaps like I am generating on lotions. Now, by the time you're able to keep a proper record of your accounting, it will be able to tell you that, okay, what product of mine should I concentrate more on? Now, this is not to tell you that you should stop selling or producing the soap. It's just telling you that, well, of all the products that you have, the lotion is giving you the highest income. So which means if you're trying to increase advertisement, there's a need for you to do more on your lotion. That's what it's telling you. One thing, do more on lotion. Now, it's also telling you that, well, the soap is not moving so well. What is wrong?
Mhm.
It also allows you to be able, okay, why is soap not selling? And it also allows you to be able to say, okay, well, maybe I need to do more in terms of the soap. What do I need to do more? Do I need to increase advertisement? Do I need to reduce the price? Maybe it's too expensive. But
Mhm.
you won't be able to know all of this by just producing and selling and keeping the money without keeping a proper record of your accounting and your money. And
Mhm.
that's why accounting allows you to be able to do this. And this is applicable to any business whatsoever. Look at Ruth, who is in the food services. Ruth will get gigs in different areas of food servicing and all of that, but she will realize that this particular line of business that I do takes more of my energy than
Mhm.
this particular one. But meanwhile, I spend more money here, I spend less money here, and I'm doing less. So, what should I concentrate on? So, that's what accounting allows you to do. It will also let you know that, well, how much am I spending? Because if I'm not making profit, what is the essence of being here? Because trust me, if you want to run a not for profit, you don't even have to be here because you're not in the business to make money. But if you are running a not for profit, you need to ensure that you are keeping a proper record of your money going out and coming in and be able to allow you to figure out, okay, am I making profit as a business? Now, in the first year or second year, maybe you may not be talking about crazy, crazy profit. But at the same time, the accounting that you keep will allow you to know whether you're on the right track to making profit or you're not. Because if you are not, at some point you're gonna have to shut down.
Mhm.
So that is why it's important that you keep a proper record of business that allows you to be able to analyze the business on from a holistic angle. Am I making profit? Am I not? What do I need to change? What is giving me the highest profit? How do I concentrate on that? Okay,
Mhm.
going on to the next. Accounting helps in knowing the true financial position of the business. I already talked about that. Accounting provides all valid financial information to owners, banks, customers, government, and other outside parties to make correct decisions. And I may have mentioned it in one of our previous sessions that when it comes to you expanding your business or getting financial support, either from family members, a bank, or an individual lender, trust me, they're going to ask you for your account because it's not just by the word of mouth that you tell me that, oh, I'm making a whole lot of profit. They're going to tell me, show me. And if you do not have a proper accounting, it's difficult for any lender to be able to understand how profitable your business are. Now, in this America of today, you are you can get money from anywhere and anyone. How much you get is going to be dependent on what volume of business you're doing.
Mhm.
And the accounting that you provide to the banker or the lender is what's going to make them say, okay, with the kind of income you are making as a business, even though you are asking for $20,000, we're only able to give you $3,000. And it's the same thing everywhere. Look at when you want to buy a house. You give them all the documents. They are going to ask you, how much house do you want to buy? It's $240,000. Okay, that's good. Give us your bank statement. Give us your W-2. Give us all your evidence of working and all of that. And by the time they run all through the numbers, they will say, okay, good. We saw what you've given us. We know that you asked for $240,000. That's the house you're trying to buy. However, this is how much we are able to loan you, $180,000. If you still want to go for the $240,000, then you have to be able to say, okay, well, with the 180 we're going to borrow you, we will need you to give at least 10% down payment. So if you have
Mhm.
your 10% down payment and they're going to loan you $180,000, the balance on top of the 240 is what you're going to cover by yourself, or you just stick to the $180,000 house. So it's not that you will not get money, but you may not get what you want. So that's
Mhm.
why you have to make sure that you're keeping a proper record of accounting to ensure that you're able to show anyone, your bank, even for you as a business owner, you need to understand the position of your business at any particular point in time. And that's why it's critical for you to keep a proper book of accounting. As a business person, there are some terminologies that you should be able to know and understand. And it's just like nursing, or it's like banking, it's like any kind of job or occupation that you do. There are some terms that you will say that they will let them know that, oh, this is a professional in this line of business. Same way with consulting, same way with banking. I have a lot of acronyms. I have a lot of words in my head that I use that only an average banker will understand. And the same thing with accounting. And you, as a business owner, you need to be able to understand these terms because they are the bedrock of your business. So, for instance, what are assets? From what we already know from the rudiment interpretation or meaning of asset, asset generally means what belongs to me. What are my assets? I have a car, I have a wristwatch, I have shoes, I have chairs, I have this. Those are considered assets, the things you own. And it's the same thing with business. Assets are resources owned and controlled by the business enterprise. And what are these? You're talking about land, you're talking about machinery, furniture. Cash in bank is considered asset for you. Your bank balance is considered an asset for you. Your stock is considered an asset for you. And so, for instance, look at let's say let me pick on Jennifer. Jennifer is in the business of moving. If she has a truck that she uses in moving items like that, that is considered an asset for Hudson Movers. All these dollies that she uses to be able to get customers' items in and out, they are considered assets for the business. If you have money in the bank in your savings account, it's considered asset to the business. And what are the different type of assets that we have? Fixed, current, and investment. And what are the differences between all of this? A fixed asset will be considered something like the machinery, the land, any computer, television, trucks, your car. Those are fixed assets. And that's because they are longer in nature and it takes a while for you to be continuing using them. You're not going to buy a laptop today and expect that it's going to spoil tomorrow and buy another one.
Mhm.
So any long-term property of the business is considered a fixed asset. Current assets. These are assets that are easily convertible to cash. These are assets easily convertible to cash. And the one major current asset that you have is your cash in the bank. Another current asset that you have is your investment, your stocks. They are easily convertible to cash and they are considered current assets. Okay? If you have loaned money to someone, say Isaac and Philip decided to loan Miriam Miller Miriam E. Miller LLC $2,000. That loan to Miriam from me is a current asset because I loaned it out. It's expected to yield interest and it's coming back to me.
Mhm.
Okay. Same thing with investment. Investment is an asset for you. You have shares, you have stocks with businesses or other outside parties. That is considered an investment, an asset for you because it's part of money that you can use to run your business. Because if you are running low on cash, you can decide to contact your broker and say, wait, please, can you liquidate $3,000 out of my investment? I need it. So that is an asset for you. Okay. Now, fixed assets. These are assets purchased for a long period, usually more than 1 year. Land, building, plant, machinery, vehicles, furniture, and office equipment. These assets form the basic infrastructure of the company, and these assets are not held for sale. Those are your fixed assets. And what are the things that comprises of the fixed asset? It's enormous, but anything that you buy that you can use for more than 1 year, you don't have a plan to sell it, are considered fixed asset for the company. And they all have each of their categories: furnitures and fittings, machinery and equipment, computers and accessory, cash and investment. All of those have their own different categories when you are classifying them in accounting. What are current assets? These are assets, or these assets are required to carry on the day-to-day business activities. And what are these? Inventory, raw material, work in progress, and finished goods. So I'm gonna pick on Marian again.
Uh-oh.
Marian has an array of products that she's selling. If she has not sold those products, she has bought them, the raw materials, she has produced them, she has packaged them, but have not sold them. Those are considered assets.
Mhm.
Any raw materials that she's bought, that she has in stock, that she has not converted into a product, is also considered an asset, but in this case, an inventory. Work in
Mhm.
progress, finished goods, all these are considered assets. As I mentioned to you earlier, your cash in bank is your asset. Your bank balance is your asset. Anyone that is owing you, or any money that is owed to you, so which means I decided to borrow someone $2,000. That is an asset for my business because
Mhm.
it's part of what we call receivables. Receivable means monies that I'm expecting to come back into the business. And those are what we call current assets. So
Mhm.
fixed assets, current assets, and then investment. What are investments? When a business enterprise puts its surplus funds in shares or bonds of government, it is known as investment. Investment generate income in form of interest and dividends. They either generate gains or losses when sold. And we all understand the business of shares, bonds, and stocks. It's not guaranteed. You can put $5,000 there tomorrow, and for whatever happens in the system or in the economy, things turn around badly, you lose some money. But in any case, whether you gain or you lose, that investment that you made is still an income, or what we call an asset to the business. Any questions so far? Okay. What are liabilities? So we have talked about assets. Now we're saying what is liability? So we say asset are the things that we own. Liabilities are what? The things that we hold. Liabilities are obligations of the business enterprise payable to outsiders and to owners of the business. So during our last session, we were talking about, oh, I am trying to, as a startup, I don't have a few things. I don't have a laptop, I need one. I need to register a business. I need to buy my machine that I will use to print my labels, all of that. Because the business has not started, business does not have money to be able to buy that. As the owner of the business, you are able to provide money for startup expenses, which is considered owner's capital. It could also be called owner's equity, or it could be called owner's investment. Now, three things that I've said: owner's capital, owner's equity, owner's investment. Now, all of this, they're only terms and names depending on how we want to treat it. If it's owner's equity, it means that is your contribution to the business that you are not expecting back. You just pushed it in to allow the business grow. Owner's capital, it means this is money that I used in setting up this business, and if and when the business is good enough to be able to pay me back, I need my money. And of course, owner's investment. If you put money in the business as an owner's investment, it's an investment which you're going to be only able to reap based on what profit the business makes. So the $10,000 that you expended in starting the business as an owner's investment, you're not going to get the $10,000 back. But at the end of each year, if the business makes a profit of $2,000, you can choose to take $250 as interest or as dividend, mostly dividend, from what investment that you made in the business. And this can be an ongoing basis for the life of the business. So owner's capital is whole by the business. Any borrowings that you do, you borrow money, your credit card, any amount you spend on your credit card is borrowings. Any money that you borrow from any family member to be able to run the business is called a liability. Any money you get from the bank is called a liability. Even though you're getting that money to be able to run the business, it's liability because you have to pay back. Creditors. So for instance, your business is established enough, and then you get raw materials on credit from this particular merchant. Until you pay that money back in full to the creditor, it's still considered liabilities for you. Payable. Payables are monies that you owe to pay back on a frequent basis. So for instance, you have a car note, that's a payable for you. Your electricity bill, that's payable for you. Your credit card bill, that's payable for you. Yes, anything that you have to pay back is considered a liability for the business. So two things: assets and liabilities. Assets are the things that you own. Liabilities are the things that you owe. Just look at it like that: own and owe. And that will be able to allow you to know, okay, this money, the way it came, it's a liability because I have to pay back. But this, oh, I own this. This I do not have to pay back. Types of liabilities. There are two major: long-term liabilities and current liabilities. Your long-term liabilities are any payable after a period exceeding 1 year. So for instance, if you get a loan from the bank that says you pay it back over 3 years, that's a long-term liability for your business. Owner's capital, bank loans for more than a year. So those are long-term liabilities. And just in retrospect, what are current liabilities? They are monies or payables that you have to pay back within 1 year. And those will be creditors, payables, bank overdraft, short-term credit. Those are what we consider current liabilities. Any liability payable within a year, or liabilities incurred in a day-to-day cost of doing business. So you buy materials from a company they give you on credit. You pay the one from the last time. You take the new set of order on credit. Those are current liabilities because you pay them over time during the course of the running of the business on a day-to-day basis. Creditors, payables, bank overdraft, or short-term credit are considered current liabilities. What makes up your balance sheet? And there are two components of a business accounting. There is an expense sheet, which can also be called the profit and loss, and there is a balance sheet, which will determine what your assets are and what your liabilities are. So, balance sheet, your assets and liabilities. Your expense sheet or income statement, which is also called the profit and loss, is your income and expense sheet. So just make it like this. What is a balance sheet? Your assets and liabilities. What is your income statement? Your income and expense. And those are the two major components of accounting. Income statement, which comprises of your income and the expenses that you incur, which will eventually give you what we call a net profit. Meanwhile, your balance sheet is your assets and your liabilities. And that is what is going to tell you the net worth of the business. Okay? Basic terms, continue. Income. Business activity generates various types of revenues and incomes. Thus, income is what the firm earns. And what are the types of income? Income from sales of goods, fees from sales of services, interest and dividend on investments, cash discounts, rent received, gain from sale of investment. All of those are what we call an income to the business. And put simply, any money coming in activity is considered an income to the business. And it doesn't matter whether it's a service that you provided, or it's a consultation that you did, or it's a product that you sold, or it's a service that you rendered. As long as by so doing, you generated some type of monetary income into the business, that is what we call an income as far as the business is concerned. And any business that calls itself a profit-making business will have at least one income generating activity. Otherwise, why do you call it a business? Mm-hmm. There is at least one income generating activity before you can call it a business. Because if you don't make income, it's a not-for-profit, and you don't have to be doing all of this. Expense. Many expenses are incurred in the course of business activities. And what are these? Raw material purchased, wages and salaries, gas and transportation, office rent, as advertisement expenses, loss on sale of investment, printing and reproduction, tolls and parking, car notes. What other thing do we have? Utilities.
Utilities. Mm-hmm.
Utilities, buying of office equipment or office miscellaneous items like buying papers, buying pens, buying folders, buying files. all of those are considered expense to the business. So in literal terms, any money that comes in is considered an income, and any money that goes out is considered an expense.
Like if I'm out shopping for uh, supplies for my business and I get hungry, then I go buy myself lunch. Is that considered an expense because I'm out working on the business?
That is what we call meal and entertainment, which is allowed as a business as well.
Mm-hmm.
Yep. Meal and entertainment. Let's say you decided to buy materials. Let me say not materials. Say you needed you needed a Crocs, you needed an overall, you needed an apron, you needed gloves. All of
Mm-hmm.
those transactions are business expenses and can be categorized as supplies and materials.
Yes.
Supplies and materials. And you will find out that some businesses will have a few things in common in terms of gas and transportation, in terms of office expenses and administrative costs. But a lot of businesses will have different kinds of expense titles. So let me take it for example right now. Hudson Movers and Rehoboth Food Services both incur expenses on their business. But while a typical Hudson mover will consider a transaction to buy tapes, dollies, and all of that as supplies and materials, it's not the same thing with Rehoboth, who is buying rice, beans, plantain, because those are raw materials, purchase of raw materials. But in what we are trying to say is that even though they are considered the same thing, Hudson Movers is buying things needed to be able to make business happen. Rehoboth is also buying things that she needs to be able to make business happen. But they are considered two different things or two different names. So that's why you also need to be able to tailor your chart of account to your business. Raw materials is different from supplies and materials that you need to be able to run business. And it's only because we are in two different kinds of businesses or we're in two different lines of business. It's the same thing. However, what do we have in common? If Jennifer decides to buy food while making those purchases, it's considered meal and entertainment. If Rehoboth also decides to buy food during the course of doing business, is considered meal and entertainment. And the business allows you meal and entertainment because they know that in the course of generating leads, you need to be able to bring your clients out, take them to lunch, spend some time with them, have drinks together. And that's why it's a transaction that is allowable for business. And it has a category and it's called meal and entertainment. And the kind of transactions you can do as a business is enormous as long as you can justify that business.
Mm-hmm.
Okay. So financial performance. So we have mentioned income and expense, but how do we know that we are making profit or we are making a loss? And it's simply put, excess of income over expenses is what we call net profit. So which means if after all of the income or money that came into Miriam E. Miller LLC is $3,000. And by the time she captured all the transactions that she was going to be doing for that particular period of time, she spent $2,100 out of $3,000. So what Marian has left or have left is $900. That is what we call a profit. The excess of your income over your expenses is known as net profit. And it's the opposite way too. If you say excess of expenses over income is called net loss. So which means if Miriam made $3,000 for a particular period of time and you spent $3,900, the $900 that you spent over the 3,000 income that you made is what we call a net loss. So for that period, Miriam made a loss of $900. But every business strives to earn profit. So what this allows Miriam to do, or any other person who is running a business here, is letting you know that, okay, I made a loss of $900 at this time. What was responsible for it? All right, I think I spent more on raw materials, which is a good thing, because if you spend more on raw materials and you still have those raw materials in the store, at some point, all those raw materials will come into play to help the business grow, because you're going to produce them and you're going to sell them eventually. So it's not a bad thing that you had some losses because of some raw materials that you purchased. However, if you do not have raw materials, and at the end of the day, you've made a loss of $900 on a consistent basis, then something is wrong. Your expense. So what it means is that, okay, if you're making $3,000, how can you keep your expenses below $3,000? That's the question you should be asking yourself. A lot of times, the reason why we make losses, or the reason why we cannot figure out what exactly is going on with the business, is because of what we call co-mingling. Co-mingling is as a result of you not being able to delineate business from your individual self. Whatever is not a business expense should not be taken up by the business. But because we are the alpha and the omega of the business, we tend to be able to do things not in the proper way by just doling out our business debit card or credit card to make purchases that are not truly business related. And that's what we're doing, is that we're killing the business even before it grows. Now, don't get me wrong. I'm not saying you can't take money from the business to run personal expenses. What I'm just saying is that if you run a proper account of the business, you will be able to know how much to take. Because if the business has $3,000 in the bank, how can you incur an expense of $5,000 for yourself when the business cannot even take it? So a lot of times we are the accountant of the business, but the accounting is in our heads. We're only looking at what we have in the bank. We're not looking at any expenses that we need to incur to keep the business running. And that way, we are commingling transactions and we are not running the business profitably, which will in turn let us begin to ask ourselves questions. If you don't ask yourself that question, the federal government will ask you the question. Because if you are not making profit, they will not expect you to pay taxes. If you don't make profit and don't pay taxes the first year, the second year, and the third year, guess what they're going to ask you? If this business is not profitable, shut it down.
Yeah.
Shut it down. So that is why it's important for you to keep a proper accounting of the business. I've run through a lot of things, but I wanted to make sure that I take you through this rudiment of accounting so that you can understand what your responsibilities are to the business. I'll take questions now for anyone that has. We have about 14 more minutes.
I have a question.
Go ahead.
Okay, so when like starting a new business and, learning, um, examining and constantly looking at your business, even though that you may have a right to take certain expense, like example, like sometimes like we may buy lunch for the laborers to move, especially if it's long hours, we may buy them lunch, but when when just because you can take an expense, when do you think is when do you think you shouldn't? I mean, when do you? I'm trying to think. How do I answer the question? How do you? How would
Pay a
you
bill.
decide whether or not just because you can take the expense is the best? Because sometimes you can, kind of like, I don't know, like you can almost like write everything off almost, even rightfully so, not even trying to do anything fraudulently and everything, when
So if I'm getting you right, this is more of a moral question, right? Why should I do this? Even though I'm able to write everything off as a business, when should I not do it? Right? So the thing is this, and I tell people that as long as it's a transaction that is needed for the business to run,
okay.
there is no moral justification for you not to take it, right?
Mhm.
You're using laborers to work. If they are not appreciated, you're not going to get them tomorrow. So it
Yeah.
doesn't matter if your bill on meal and entertainment is so high, because these are justified transactions, right?
Yeah.
So there are some transactions that even within you, there are sometimes, and let me tell you, I'm on record, I'm recording this, but this is between you us. I could go into a Ralph Lauren shop and buy a shirt for myself and decide to call it a business expense. And what is the moral justification? If I am telling or teaching someone about wealth, I want them to see me that I'm doing so well that they want to do the things that I'm telling them to do.
Mhm.
You understand? So, my buying a Ralph Lauren shirt as a business expense is not just because I'm frivolous, it's because I need to show that what I'm preaching to you, they say, what I'm preaching to you is what I want you to imbibe. If I'm telling you that you can make wealth in this, I'm telling you, then show me how to live my life, or show me the things that is different in your life than mine that you can do, or that I should do, or I should believe you from. So there is nothing stopping you from buying a Ralph Lauren product. There's nothing stopping you from buying a Gucci bag or a Coach bag. For me, as long as the business can take it, you can have $1,000 in the bank account for you to run the account and then go and spend $950 on a Coach bag because you own the business. What if an expense comes tomorrow, which is a true business and genuine business transaction? What are you going to do? Then you're going to incur a debit or a liability on behalf of the business, because whatever bill that needs to be paid needs to be paid. Sometimes you know when you can spend money as a business owner, but a lot of times we overdo it, and that's what runs us into trouble. So, to answer your question, Jennifer, there is no transaction you cannot do or justify as a business. However, when you're talking about moral transactions that you can do, just ask yourself, is this the best thing for this business at this point in time? And don't get me wrong, what if it's the only livelihood that you have? What if you don't have a 9 to 5 job? This business is what is going to help you fund your lifestyle. You're going to pay your mortgage, you're going to pay your car note. All these are transactions that you can decide to call business as long as the business can justify it. If the business cannot justify the transaction, which means the business has $3,000, this expense is about $10,000. How do you want to even cope with that? Your mortgage will always come on a monthly basis. So that is what the accounting will tell you to do. Okay, if my expenses on a monthly basis, both business and personal, is $6,000 and I'm making only $3,000 a month, I need to do something more. So you can write off a lot of things as a business owner, but you also want to ask yourself, because the question that you need to guard against is this. You can get away with it up until IRS decides to say, let us audit this business. And at that time, trust me, if IRS decide to call an audit on you, the chances that you come out of it unhurt is low, because they want to see everything, your receipts, your every transaction that you make. And you may not have receipt, and that's why I made something the last time we talked. At least let all the transactions that you are incurring on the business account, let it come directly from either an electronic transfer, a debit card transaction that will show the name of the merchant, and it will be easily described. Okay, well, they can see, oh, this Ralph Lauren store. You want to tell me that you are in the business of producing cream or railboat services, who does food services? You need a Ralph Lauren shirt to be able to cook rice. Is that what you're telling me? You understand? So even though they will permit some of these transactions, but when an audit comes from IRS, they will dig into everything up until the last 3 years of business. So
you know what I noticed last when I was looking into my account, I because I did I in the business account, I have me and my partner's life insurance coming in out of that, because that's part of our what we're using right now as part of our
guarantee.
important, like if something happens, like I forgot what you call that, but and so that comes out of that. And I noticed when my partners was the first transaction that came out, it just says, what it is, but it had in there where when I opened it up, that I could put a note.
Mm-hmm. Yep.
And I'm like, oh, that's pretty cool. I said, man, if I use this, it'll make it very helpful.
Absolutely. Absolutely.
Like what all that transaction's about. Like I do, to go in and do a note.
You can do that in your account. So let's say the transaction came yesterday and you see it and you looked at it, it looks difficult for you to quickly understand. You can click on that transaction on your bank statement online and put a description of it now that you remember, rather than wait for the next 2 years when you'll be asked and then you'll be like, what is this? I don't know. That is an option for you. If it's an easily identifiable transaction, you don't have to do anything. And that's the way the business allows you. There are so many things that you can write off as a business. You just have to be morally responsible to yourself and be morally responsible to the business.
Just so as an example, like U-Hauls, obviously, if I did a transaction for U-Haul, I was like, might have been renting some blankets or some supplies. So I really didn't have to list what I got that day if I didn't have, have the receipt, because that's obvious. That's an obvious.
Exactly. You bought something from U-Haul supplies and materials, period. Now, if it's rental, because you're going to send it back, you can classify it as rental rather than consider it a supply and material, because supply and materials could be your own eventually. But if you are renting it such that you have to take it back to them, classify that kind of transaction as rental. Now, what this will also help you to do is you now begin to figure out how much is it costing me to rent in a whole year. And as against, what if I decide to buy these things myself? I don't have to rent it anymore. It becomes my own property And the money that I spend on rental, I don't have to spend it on it anymore. So these are some of the things accounting allows you to do. Okay, now you're spending $7,000 in a year on renting things, renting dolly, renting blankets, and all of that. Meanwhile, if you spend $5,000 on buying these things, yes, it may not be enough, but at least you have some things that you want to start with. So this is what accounting will allow you to be able to do. You'll be able to see, okay, how much of my money is going into this? Why should I be spending this much on this? Do I need to move some funds out, go and buy these things myself? And then it allows you to be able to ask yourself questions. Why you're spending this much on this category of transaction? That's a great question. That's a great question, Jennifer. Any other question from anyone else? It's 10:57. Any questions?
Sounds like an operator or something. Yes, not.
Nothing from anyone? Okay.
It's
Yeah.
not.
Go ahead.
Hello. I think it's more of like the example you mentioned about buying stuff, and then really I'm not making money from the first transaction I'm making with it. Okay, I buy a 25 pounds bag of flour, but really I don't need all of that to make maybe a transaction as in 12 pieces or a dozen of that for a customer that asks for it. But I have to buy in bulk in order for me to make profits. Because if I don't buy in bulk, I lose by buying in pieces or at the retail store. So I go to the wholesale store to get stuff like that. Now looking at that, will I call that transaction that I made out of it a loss because I didn't make money from it in essence, because I've practically used the whole amount to get more stuff?
Now, let's say you buy a bag of flour and a customer says, just do me a dozen. We all know that you're not going to use the entire bag that you bought to be able to do the 12 dozen. However, if another customer comes and say, do me another 2 dozen, will you still be able to use that bag of flour?
Sure.
That's not what we call a loss. So if you recall that I mentioned earlier in the session that purchase of raw materials at some point is considered an asset to the business. It's the current asset. So at the time when you bought it, you didn't need it all. But what does it profit you to go and buy a bag for $7, a small bag for $7 that will do 12, and then you buy a big bag for $15 that will do 36? That is a business sense. That's a business decision that you made by buying in wholesale, and you're going to use just some portion of that bag to cater for this customer. And by the time the next customer comes, you are not buying that flour again. So you're going to make your profit by the time the second and the third customer comes. So let me give you a typical example in consulting. There is an app that allows me to be able to generate agreements. So maybe I want to do a partnership agreement for a client. I want to do rental agreement. I want to do company bylaws and any other type of agreement like that. It costs me $600 per annum to be able to do that in a year. Now, I have a client who wants me to do them a partnership agreement. My fee for that is $450. Now, if you look at it technically, I've made a loss because by just this customer, I have made a loss of $150 because I'm only going to charge them $450. But this was February, earlier this year. Between February and now, I have seen 5 other different clients who has requested for one kind of agreement or the other, and my price still has not changed from $450. So imagine that I did one in February, and between February and now, I have another 6 450 times 6 is about over $2,400. Have I made my money back?
Yes, you have.
Absolutely. And that's the way you need to think as a business. If I want to do that thing part time, if I want to do it part time, they are going to charge me $129.99. If I decide to say, I will come and pay for it when I need it. So I will charge the customer $450. I will pay $129.99. And then all I'm making at the end of the day is less than $300. Meanwhile, it will cost me $600 only for the entire year of 12 months. So that's a business decision. You will not consider that as a loss because eventually you're going to use the entire bag of flour eventually. The only time you now need to rethink is if you decided to buy a big bag and you are not able to use it again the moment you tear it open, and all this customer is asking for is 1/4 of the big bag, it doesn't make sense for you as a business because the moment you buy it, you can't use it again. But if you are able to use it over and over again, it's just like you buying, a customer says, come and help us with setting up tables and dishing out food. You know that for your business to look good and presentable, you need those things we call chafing dishes. Now, the entire gig for this customer is $1,800. But in order for you to be able to buy 6 chafing dishes that are looking good, it will cost you about $3,000. If you look at it like that, income and expense, you've made a loss. But if you use this chafing dish for this customer at this time, are you still able to use it for another customer that comes tomorrow, next week, next month, next year?
Yes.
That's absolutely. And that's the way to think about it. Because that is considered an asset for your business. You own it at that time and you will make your money over time because you don't have to buy the chafing dishes every time a new customer comes.
Thank you so much.
Thank you. Thank you. Any other question from anyone else?
No, sir.
Thank you. Thank you. It's 11:03. We've come to the end of this session today. This session is recorded. I will also share the session with you like I used to do. I'll also share this slide with you all, just so that you can have it for your record as well. I want to thank you for jumping on this session with me this morning. Our next session will be Tuesday, July 5th, with Rich Crable, who is going to be able to practicalize using QuickBooks to run a business like we've just done in theory right now. And after that, we'll be able to see whether we need one more session where we can tie both together or not. But I want to thank you all once again. Mr. And have a great day.
You all too. Thank you.
Have a
Thank
great
you.
Thank you.
Thank
Uh-oh.
Thank you.
Here we go.